Hi, this is Tom Savantry of Premier Trust Advisors. Today I want to cover a topic called volatility buffer. And what we're going to illustrate today is a typical qualified type plan. This could be a 401k plan, an IRA, but now you've accumulated money within this account over time, you've saved and invested, and now you're in a position now to take withdrawals from it. So in this scenario, we're going to say you're at age 65 and we'll do a 20-year sort of time period. And we're going to assume you have $1 million in the account and, an earnings rate of 12.7%. And that's based off of a time period that I took here from 1970 to 1989. Pretty robust average rate of return over the course of that time. That's the S&P 500 with dividends of 12.7%. So that's where we're going to use that just for an illustration for this example. And say you're within these years, you're going to take out $100,000, 10% of the starting account value every single year for your use. And as you see here, if you were to earn 12.7% every single year with no down years, that it would amount to $2.1 million, even if you've got to use $100,000 of pre-tax money each year. So the reality is, though, that the market doesn't work that way. It's not going to be the same amount every single year. So if we look at the history within this 20-year period and use the actual returns that occurred during that time, you may see a different outcome. So here, at the end of the 20-year period, you're actually now negative in this account. And that year, when you're at age 78, you've actually run out of money in this account. So why did this happen? Well, when we look at the details of it, you'll see that in certain years, in year 68 and in 69, there were some significant down years. And when you've taken had a down year and then taken money out, it actually causes a severe sort of impact to this account balance. So from going from 67 to 68, you drop from $1 million in the account value to $777,000. So over 200 plus $1,000 change in account value over the time because you had the loss in the year and you took money out of the account. And we know losses in these accounts are going to have a much significant impact than the increases in gains. So what if you were able to provide some buffer to this in those down years and did not take as account, but you withdrew money from somewhere else to fill the gaps for that year? So in the years after there was a down year, you didn't take anything out of this account. What would that look like? So if we play that out, say after year 68, when you're 68, you didn't take anything. After 69, you didn't take anything. But then you resumed your $100,000. And now, look what happens. Because of that volatility buffer, you're able to obtain money elsewhere to supply your living needs, that this account now grows to $1.47 million after the 20-year period, because you were able to deal with the fluctuations and volatility of the stock market and provide some level of liquidity from somewhere else to fill the gaps in those years when the market goes down. So having the liquidity available to you is going to be key, and you have to build that over time. Now, you also don't want to just store it in something that's going to earn virtually nothing. In this day and age, whether it be a bank account, money market account, you're going to be earning very little and not even be able to keep up with inflation. So there are alternatives to build up liquid cash in a tax advantage environments that are going to earn you above inflation rates, and that can really help sort of work in tandem with these qualified plans so they work better together. So I hope this was helpful just to give you a flavor on the importance of having liquidity on top of your taxable accounts as you start withdrawing them, because you're going to see that it's going to be working much better for you in the long term.